Hello, everyone. This is Jeff Wilson with Govy Rates, and today I'll be making a presentation on how to make money in government contracting. Something that seems some may think is so easily to do, but can so easily be mishandled, and you can end up losing money by being a government contractor. Today, in our session today, we're going to talk about how to ensure that you make money using your pricing and your accounting system. A little bit about myself. I'm a CPA in the state of Maryland. Last year, 2023, I was Young CPA of the Year, considered one of the top 40 under 40 CPAs by Accounting Magazine in 20 and 22, one of the top 40 under 40 Black Centennial CPAs. I'm also an author of the book, The Lies Our Parents Were Sold and Told Us, as well as a member of Intuit's Trainer Writer Network and Intuit's Accounting Council, as well as I'm a member of the American Institute of CPAs Executive Committee for Practitioners, as well as the PFS Financial Planning Committee. A little bit about myself before we move to the objectives. I've been a practicing CPA now for over 15 years, specializing in government contractors since I started my practice to now. I will add that now I like to say that we also drink the Kool-Aid that we give everyone to drink. Our firm is also a small business 8A, MBE, DBE in the state of Maryland and Prince George's County. So we are also a government contractor as well as a state and local contractor. So we live this. We use the tools that are in this presentation to also ensure that our company stays profitable. I tell you, we had one unprofitable year in our existence. Welcome to COVID, and I was sick there. And the way that we've been able to manage that is by managing our pricing and ensuring that we have that just really tight. So in our course objectives today, we'll be talking about the necessary accounting outputs you'll need for your pricing, right, to make sure you can make money. Practical examples, we're going to do a little bit of a scenario so you kind of can understand how these scenarios kind of relate to your actual business and how you can see yourself in action and realize, hey, these are a few things I need to do to make sure we get our pricing right. So why are we here? First rule of money, according to Warren Buffett, is the first rule of investment is don't lose money. And the second rule is remember rule number one. Okay, so we're all here to make money. Some of us are here also to be altruistic, to help our government, to help our state and local and our communities. And that's all great. We should do that. That's a great mission to give back and help our communities. But also, we're here to make money, to not lose money. And I'm hoping with this presentation, we'll make sure you don't lose any. So in government contracting, there's a number of types of contracts, right? It's just like the alphabets of government contracting, A, B, C, D, all the alphabets. But the same thing happens in contracting. You have a lot of contracts types, firm fixed price, cost reimbursables, T&Ms, which we'll really focus on in this presentation. There's IDIQs, multiple award contracts. So as a government contractor, if you're new to government contracting, you definitely want to get up on the lingo. There's a couple of great books about this, but you want to read about it just so you know what what type of contracts you're going on. The more likely that you're going to see are the firm fixed price contracts, the cost reimbursable, and the time and materials. And so we'll talk a lot about those in today's presentation. So the most used, as I mentioned, firm fixed price. You'll see those a lot in commercial businesses where there's a fixed price. You just really know your top line, and it's up for you as the contractor to manage that bottom line. Cost reimbursable. A lot of times the government will say, hey, give us your cost, and then you can add your profit fee to that, and we're willing to pay you that. And then you got time and materials, where it's, hey, what's your labor rate? You tell us what your labor rate is. We'll accept that by the hour. And then, we're both good. So any of these methods, they come with some particular risk depending on who you are, what side of the deal you want. Cost plus pricing is a way of the government ensuring that a certain amount, that no one's overly profiting on them. It also ensures that they know that whoever they're doing business with has great accounting, knows their operations, etc. So it's a bit of a kind of maybe a 50-50 ground there as far as the risk that's being taken in cost plus. But I would say it probably tilts a little bit more to us, the supplier of services or goods. And the reason is your cost can actually increase after you give the government your pricing. So on cost plus pricing, you tell the government my cost for providing you services is this plus my fee. And what can happen is during the year, your overhead or your G&A may go up. As a result, your pricing may increase and be higher than what you originally quoted your pricing that you're currently providing services to the government. So that's why I say a little bit of the risk is on the supplier side of it. Uh, Time and materials. I think that's a kind of a good fair 50-50 deal. The risk is pretty evenly spread. The key thing there is the government saying, hey, give us your hourly rate. The key thing is for you, the contractor, is to know your hourly rate, but to make sure all your cost is very similar to plus pricing. Make sure you've captured all your cost in your time and materials hourly rate to make sure you're actually billing the government and giving them a rate that you can actually make money off of. And that's one thing that a lot of people have a tough time with time and materials. They typically base it off of base rates of labor and don't add in all the other costs it takes to actually run the business. And then fixed price, I think it's the easiest one. The sole source contracting, a lot of that is fixed price, at least when the smaller contracts, some of the hubs don't work. And I think I always say that it's the gift and the curse of government contracting, especially if you have a lot of this early on, because the fixed price work doesn't really force you to do pricing. It sort of says, hey, here's the top line and you manage your profitability up or down. And most of the fixed price work is based on stuff that the government knows the project very well. So they know how much time, they know the effort, so they can feel comfortable getting a fixed price. And then you, as the contractor, if you know the work well enough, you kind of know how to manage your costs to make money. The problem with it is that with fixed price, it doesn't allow you to exercise or practice knowing your pricing. And so whenever you move to the next level of government contracting, time and materials, cost plus pricing, you haven't had the reps in building your pricing, and a lot of people end up losing money, or they find themselves not being able to win work when it's cost plus pricing and time materials because they had so much fun in the fixed price land that they haven't had those reps and that experience there. So those are some of the difficulties, that kind of come with that. And so we talk about those there, and I kind of got a little ahead of that slide, but yeah. So we're going to do a scenario here, right? And what we want to do with this scenario, we're going to go through those three methods of pricing, and we'll talk about what you need to do your pricing. So anytime you do your pricing, there's a few things you're going to need. One, you're going to need an accounting system, and you need an accounting system that can tell you your cost. Okay, you got to have an accounting system. That's the first thing on the list. And so we're going to go through this, and you'll see how the accounting system kind of plays into this. So in this scenario, imagine you're a government contractor trying to price your labor for a contract valued at $140,000. You got your labor category. You know the labor category. You got your person. They're going to be an $80,000 salaried employee. We're just rounding this off a bit, so take it at 2,000 hours at $40 an hour. 40 times 2,000, that's your $80,000 salary. Some things that you may or may not have during pricing, depending on how your accounting system, what you're using. But you'll need this is you're going to always need to know your indirect rates, your fringe rate, your overhead rate, your G&A rate. Okay. No matter what, you want to really know those before you start on our pricing. And now we're going to go to our scenario. Based on the scenario, we're going to go through some pricing methods and talk about cost plus, right? So what I've done here is actually in this scenario, I've basically provided you the indirect rates, even the wrap rate. And then we're going to look at, okay, we're trying to figure out what are we pricing, where we're going to make. So we know the employee is going to cost us $40 an hour. And then in a cost plus scenario, you're telling the government your cost and adding a fee. So typically, fringe cost, Social Security and Medicare is 7.65%. In this case, this organization, their fringe rate is 9.65. And the reason for that is their cost of operation of labor is 9.65, meaning there's Social Security, there's Medicare, and there's probably some other things like holidays. Maybe they're paying gym memberships, there's fringe benefits, who knows? But they know that their fringe rate is 9.65. That all comes from the accounting system. And then this organization also knows that their overhead rate is 27.83. As a result, that 27.83, when applied to direct labor, it gives them $11. And same thing goes for the G&A rate, which is pulled from their accounting system. gives them $8. And so their total cost of labor, right, is $63, right? Because they have the labor cost and what it costs to basically run their organization, what it costs to pay the owner, his portion, whoever's the admin, all of that actually equals up to a $63 unit cost or hourly cost for this particular person. So what you'll see is that, okay, its cost is 63. What's, remember, cost plus fee? In this case, they're saying, hey, we want a 15% profit margin. And as a result, a 15% profit up on the cost here says we're going to bill this person out at $73. That's how we're going to make a profit of 15%. And we're going to have a profit margin of $10. I really like cost plus pricing because if you do cost plus pricing, I think not necessarily the right way. You always want to do it the right way, but cost plus pricing really helps you get that target range where you want to. And that's why I say even if you're doing fixed price, which we'll go over, you want to do some cost plus scenario calculation to make sure you're getting it, because you see you're getting that margin. What I always tell government contractors or any of my clients is, what's your profit fee? What is your target? Right? For us from the services, 40% gross profit margins are acceptable. That's what we want. Excuse me, 60. And if it's not that, we probably maybe don't want it. And our target net profit margin is 30%. And as a result, if things don't fit that criteria, we tend not to bid or be involved in it. Which means you have to say no a lot once you know what your target range of profit fee is. And so what I would say is always go through practice the cost plus scenario from this standpoint here. It'll really help you to ensure that you're actually making money and you're making what you want to on your business and your services. So we'll take the same scenario again, and we're going to do time and materials. And this is where I see a lot of contractors kind of have a lot of problems. So you'll see here, the indirect rates, but these aren't just indirect rates; they're dollar amounts, etc. And so we have the same employee, $40 an hour, and then we have the fringe costs. We took the standard. What people will do, say, okay, I got Social Security, I got Medicare, I got these taxes, and if you do that, you end up with $3. And you'll see that the overhead, the budgeted costs, which you see, we're saying, okay, we got overhead. Typically, this organization has $37,000 in overhead. So we divided that by 2,080 hours for the employee, right, to kind of smooth it out. And what you're doing, why we did that is to say, hey, if an employee, what do we need to cover in hours in order to recoup that cost? So if you do that by 2,080 hours, it says, okay, $18. And we did the same thing here for G&A, divided by 2,000 says $4. And that gave us a total cost of, okay, will we pay the employee and what we need to do to recoup our operational costs, we get 65. I like this scenario, and I talk about it a lot because, and you can raise your hand or think about it, how many people do back envelope math? And what I say about that is some people take the $40 they're going to pay an employee, says, hey, we're going to put $20 on it. If we do that, if we do $20, that's about a 25% markup. And if we, a little bit more than that, but they'll say, hey, we'll put this on it, and that's going to make sure we make money. But that's back envelope math. Back envelope math very rarely calculates enough to get you enough profit over the overhead and G&A costs. And that's why I like the cost plus scenario, because it ensures you're recapturing all the costs you need. And you see in this case here, $65 profit fee. You can basically say, hey, we're going to add still a 15% profit on top of that, and we're going to end up with a cost plus. We're going to end up with our time and materials rate that we want to bill is $75, right? And so now we know we're going to make some money here. And now also our cost is 65 here, so we're making $10 an hour. And very similar to the approach before, you'll see here, you a little bit of a $2 difference in there, but get to the same point. Meaning when I say $2 is just the unit cost here, 65 on time and materials here. It's cost plus is 63, but the profit end up being the same because the cost just adds up. And then you got fixed price. And remember, fixed price is where the risk is a lot much on the contractor, and it can get. I've seen some people win big and win well on cost fixed price, but you got to be careful because if you don't manage it well, then it could be a bad thing. especially if you got some SCA work and you don't know how to do the payroll there. It can be a big pain in the butt. But so here on fixed pricing, you know it's 140,000. You know with that in the scenario, you know you're getting paid that, and you know, right? You can kind of thinking $65 an hour to the cost of this person is $65 an hour, right? Times 2,080. I got 135. I'm going to really net profit on this contract is going to be 4,800. You can't calculate your profit fee in here. So because it's just the way it works an hour. So if you notice the profit fee is a little bit smaller, you're getting what you're making per hour is $2.03. And that's why you always kind of got to be careful about fixed price contracts because you really need to know your pricing and know is it worth it from you. You know, if I said, hey, would you take 15% margins or 4% margin? You would probably say I'll take the 15% margin depending on I always take 15 and 4%. I'm only going to take that if I got a really, really big number. All right. To make it worth your while. And these are the things that in these scenarios, when you're thinking about your pricing, like I said, you really want to still go through the exercise of cost plus pricing, even when you're doing fixed pricing and make sure it's worth the go. So how do you get there, right? Well, we talked about these scenarios, but how do you get to do pricing? And the only way I've seen it done is you gotta have an accounting system designed properly to do your pricing. You're going to hear, I love the government industry because there's so much talk of what needs to be done as far as an accounting system. You need this system, you need that system. First off, there's no right or wrong system out of the box per se that's government approved, right? What it is that you must have a system that can perform a certain set of tasks. And I'll tell you that the government already gives you a hint when it comes to it. The government typically requires whether it's GSA, DCA, everyone's going to really have you really come compliant with FAR and 48 CFR. It's document SF1408. And it's the pre-award survey of an accounting system. It's basically an evaluation to say, can your accounting system do what we needed to do in order for you to be a relevant government contractor? Particularly, what accounting systems must do in order to be compliant is to proper segregation of direct costs from indirect costs, which we've kind of just went through in that scenario. Accumulate and identify costs by contract. These are the top two things. All these things must be done, but these are the top two things we're covering in this session. And any accounting system, I think, for the most part, whether you in the industry, QuickBooks, Uninet, and those, you can make those compliant, right? It's just a question of do they come out of the box, or is there some configuration that needs to be done? And then also where you're at in the spectrum. I typically say if you're a smaller government contractor, you don't need a very large system like these others. You can probably do QuickBooks Online. You can add on with QuickBooks system Govy rates, and that can help you with the basically the allocation of indirect costs as well as figuring out your indirect rates and your pricing. Very simple, easy to go, and you're there. What I also mentioned about the accounting system design is you'll hear your accountants talk about GAAP, right? There's GAAP accounting, and in government contracting, you have cost accounting, and that's where you see this CAS compliance. And it's a little bit different. I'll tell owners, don't get caught up in it. Let your accountants do their job, pay them well, so that you get really good accountants that know government contract accounting. That's going to really help you out. I would not tell you to get a generalist bookkeeper. Get a bookkeeper that knows GovCon. That's the first thing. That's familiar with the needs, and I think that it really helps out. And then picking a system, having it outlined so we can do these things for you. And job costing. Job costing is going to come up once you have multiple projects. You need an accounting system that's going to be able to do direct method job costing and indirect, especially if you have commercial. Indirect job costing means applying costing to your projects based on your indirect rates. Direct method, you just record all the costs directly to the job as they're incurred. Two different methods, two different views, but both are necessary when you're in the government contracting space, and especially if you're in the government contracting and commercial. Cost accounting, as I mentioned, it's the primary purpose is to provide you more management decisions on how you want to use labor and move it around. That is the what I say the impetus of government contract accounting. It's cost accounting more than it is gap or project accounting. And so you just got to know that you're going to, once you start getting these projects, you're going to be in your accounting system, you're going to be looking more at your jobs, your different projects to see if they're profitable. Profitable projects equal a profitable company. If you cannot monitor your projects in your accounting system or some method of an add-on, you're going to have a problem maintaining profitability. Or whenever you grow out of maybe the 8A or you lose your hub zone, whatever you don't have the advantage of fixed pricing and some other sole source kind of options, you're going to probably end up in a tough spot having to compete with larger companies that have a better handle on their project management. So cost accounting is key. It's not, I would say, once again, owners, I don't try to make my presentation heavy accounting, but you got to know that cost accounting is there. So you want to get familiar with it and make sure your bookkeeper is familiar with it and monitor your projects. An accounting system in the government contracting space, you got to have these four things. You got to have an allocation to show your direct cost, your G&A, overhead, and unallowable. Talk about these in general terms. Your direct cost is all the costs incurred directly that can be attributed to or identified to a project, contract, task order, IDIQ, etc. Your G&A are typically the costs that are not related to a project. You can't allocate them there. It's typically office rent, stuff like that. You don't really parcel those costs out to any particular job. They're just the price of doing business, whether you're in government or commercial. Your overhead costs are related to projects, but they're over multiple projects, and as a result, it's overhead. It's a shadow of cost held over these projects, but it can be justified to just one project. And unallowables. I don't talk about these a lot here, as far as because unallowables can get really deep, but unallowable costs are costs basically that the government says when you're doing your cost plus pricing, when you're talking about your cost to do business, don't include these costs in there because we don't allow them. That a lot of the unallowable costs, meals and entertainment, for the most part, I say don't even put it in there. Interest expense on loans, those type of bank fees, those type of things you do not put in unallowable costs, financing fees, etc. And so the government said, I'm not paying for that. If you pay lobbying costs, no, that's not going in an unallowable cost. So the government says, hey, we're not paying for that fourth column. So I always tell new government contractors, eat out as much as you want or drink, but you're not billing that back to the government. And so your unallowable costs are the costs that don't get captured or put in your cost plus. So how do they really get captured? If you think about it, they're eating up your profit margin. So if you had in our example, we had profit margins of, let's say, 15%, but if your unallowable costs are technically 3% of your operations, then you're really only getting 10% because the government says you can't bill it back, but the cash is going out the door. So just know you're not getting 15% margins off of them. So here's the difference. And what you'll see here, this is one P&L taken from the Govy rate system, and this is one taken out of QuickBooks system. And neither one is per se right or wrong. You'll see that in this GAAP financial accounting, which was what QBO is, you'll see this setup is typically a GAAP counting. A GAAP is just straight down the line here, the functional expenses of the organization. But as you notice in the SF1408, they want the identification and segregation of costs. And so this is showing you that segregation, that direct cost, right? The fringe benefits, overhead, unallowable. So you need this type of setup when you're doing government contract accounting. And this setup here, as you see, you can't really, I would say, ascertain from this what your indirect costs are. Here, you can use this to start calculating your indirect labor rates and the costs. Identifying your pricing. You got to consider all costs when determining your pricing. That's why it's very hard to do pricing on an Excel spreadsheet. Unless you have your entire bank account in an Excel spreadsheet, it's going to be hard to do pricing. You got to have a systematic way. An accounting system is going to be important in order to do your pricing. So rates you need to monitor. When as a government contractor, there's a couple of rates that you really need to know, some at different times, but you really want to have these, almost get these as soon as you're getting your financial statements on a monthly basis. Your burden rates, your fully burdened rates, you probably want to know those typically around pricing. I wouldn't say that's more of a monthly thing because typically you're calculating those when you're doing your pricing for contracts. But on a monthly basis, you do want to monitor your wrap rate. You do want to monitor your other indirect rates, such as the overhead rate, G&A rate, and the fringe rate. And you always want to be looking at the profit margin. Net profit margin at the bottom line, of course, I would say focus on the gross profit margin from your projects. That is the key thing to see if those projects are running profitable. And obviously, if you're getting that target profit margin, I would say a good practice is identifying what's your target profit margin that you're trying to make off your projects. That's what you need to set up and know, and make sure you have upfront the like, hey, we're in the business to make this amount of margin. Anything that goes below this, we need to either get rid of it or we shouldn't even have went after it after all. And let's make sure we don't go after small margins again. No need. Good margins are key. You don't want to be giving government loans on work or buying contracts, as I say. So calculating your indirect cost rates. So typically, right, this is a very much a simplified calculation and table. Your indirect rates, your fringe rate, total fringe cost divided by direct labor cost. Do it times 100. It'll give you your fringe rate. All right. Now, other calculations. This can get much more. What I want to say, a little bit more complex. I wouldn't say super is. Some people will add other costs to their base, the base being labor costs, meaning total direct labor costs. They may add overhead plus direct labor plus overhead labor, etc. So the what you determine as your base and your cost, you just want to use your base consistently, right? So here, G&A cost. What is G&A? What's our G&A cost? We're applying that across all our direct costs, and we're saying our G&A rate is G&A. Our direct cost is our base, then we'll apply it across total G&A times 100. That's your G&A rate. And then you got your total overhead rate. Same thing. You have your pool of cost. You have your base times 100. That's your overhead rate. Total indirect cost, if you're looking for your wrap rate, is all your indirects up above. Total plus total direct cost divided by your same consistent base gives you your wrap rate. So we don't talk about it too much here because the calculation is pretty simple. Your burden rate, right, is just your direct labor rate, your hourly rate plus your fringe benefits. So if you take basically your direct labor times your fringe rate, and that's your direct labor, that's your burden rate, the burden of the employee. And then you add the fully burden rate, which is all your other rates plus direct labor will give you your fully burdened hourly rate. And these are hourly rates. So these are in the term of dollars, right? Not in percentages. When you're calculating this. And so here, this is what you're really looking for. This is powered by the government rate system. And what you're looking at is, okay, if you, for example, in our example in the presentation, you have an employee, it's a $40 hour rate. You would just click this here. In this particular system, it processes it very quickly. Says, hey, your fully burdened rate, you add your all your indirects, you got $67.24. And if you add that 15% profit fee, you're going to bill your hourly rate on this employee is going to be $77.33 to make your money. And here goes your wrap rate, 1.681. One way to get back to this number here is to say $40 times 1.681. It gives you your fully burdened. And if you did it times 1.93, including your profit, there you go. And what you're doing on a monthly basis is that what you're looking at monitoring is that hopefully that your wrap rate, it doesn't go up after you've bid a contract at 1.681. So you would hate for your wrap rate to be 1.9 in December when you bid on a contract and one in January and it's 1.6. Because what that means is your cost is actually risen, and now you're eating into that profit margin as you couldn't contain cost and your cost went up. And I mentioned that in the cost plus slide where the thing about cost plus is you got to manage your costs. during the life of the contract. And so when you're doing that, like pricing, that's why it's so important is you got three choices there. You can price to lose, right? And you don't want to do that. The only time you really want to price to lose is when you're basically saying, being honest, you're saying, I'm going to buy a contract. I'm going to price it below what I think is market value because I need this contract so bad. And it's not about the money. It may be truly a strategic acquisition. Maybe you're saying, hey, I want to get into an agency, or I want to get something, a certification that comes with having this contract. The key thing there, it happens. It just needs to be strategic, but you want to make sure you know the risk that you're taking on, meaning, okay, I'm losing, but how much are you going to lose an hour, especially if it's time and materials or fixed price where there may be no end. You need to know, okay, my loss is not $1 an hour, it's 50 cents an hour or 75 cents an hour, then that you're comfortable with that. Pricing to win. You price the contract to meet or exceed your actual budgeted wrap rate. You got your wrap rate, you know what it is, and you say, hey, you know what? We're going to go up a little bit on this wrap rate from what it currently is. We're going to go up and give ourselves some cushion. We're at 1.6. I'm going to bid the contract with a 1.9 wrap rate. So if costs do go up, we're still making money within our green. And then price to cost. You may say, I'm going to bill it right at 1.6. I'm going to bill it at the fully burdened rate. And there's a reason for that. They've got to be strategic. Very rarely. Typically, it's for the same reason I mentioned before. You're trying to get an agency or something truly strategic that you see there. And so that's one of those ways to do that. But typically you want to avoid doing things that cost. Well, once again, the key thing and what we're doing this presentation for is to ensure that, hey, you're not loaning money to agencies or customers for contracts. You're not buying contracts. You want to get paid for them. And so to make sure you're getting paid and you're not giving out loans, you got to monitor your pricing. And how you monitor your pricing is, one, in order to do that, you got to have budgeted rates. You want to make sure that you, small businesses, I think a lot of times we missed out on doing your annual budget. Sit down and do the annual budget so you can really identify what your expected operations or future costs is. So that means some planning for us small business owners. And when we're just starting out, we don't think about it, we just go do. But you got to sit down or get the right accountant that's going to make you sit down, handcuff you to the chair and say, hey, let's talk about what the plans are for this year. Let's see if we can stay on budget. I would say that one of the things, and being in business now for 15 years, plus actually, is I didn't do a budget up front. I'll be honest, and I'm the CPA, but you want to get in the practice of doing that earlier because it's one of those things you would hate to, when your business gets older and more mature and you guys haven't gotten the practice of doing a annual budget. You want to get that programmed into your process as soon as possible. It's extremely painful. I hate it even now, but you want to get that done. It's going to give you a lot of insight for the new year, having that budget there. Profit and loss. Like I said, you want to do a full wide company. Everybody looks at the company wide, but you want to look at the company wide P&L. But you also want to look at the company wide rates. Look at those rates that's current and compare those to what you budgeted. You want to monitor these to see if your costs are going up, so you can know, hey, we're getting too close. We may start losing money on some of these projects. We gotta manage our costs. So this you want to manage on a monthly basis. Look at your P&L plus look at your indirect rates. Monitor them. Job reports. You got to monitor your project managers, your PMs. You got to monitor your projects. Look at them with the current rates being used. Is the pricing correct? Is the pricing still valid? That's what you want to make sure that you have, that you're making money on these projects. I see a lot of clients that have one great project and then two duds. And then if you don't monitor projects, the company's making money, but you got two duds and you don't see it till it's a little bit too late, or when that one project it goes away and then you get two duds and now you find out that you're losing a lot of money. So monitor your projects. Well, this makes the end of our presentation, and I thank you for attending How to Ensure You Make Money as a Government Contractor by the W2 Group, powered by our Govy Rates team. If you have any questions, please feel free to reach out to us on LinkedIn, and thank you for your time. Have a great evening.